Hello, everyone. Welcome back to the K4 channel. My name is Chad. Today, we have a really special guest with us. We have Frederick Vettese, author of Retirement Income for Life. We have a great opportunity to kind of pick his brain, ask some questions. And truth be told, I'm quite nervous and excited about this, so I hope I do it justice. Mr. Vettese, welcome here.
Hi, Chad. It's great to be here.
Yeah, thank you so much. So if it's all right, we'll just jump into it. So I'll start from the beginning. What inspired you originally to write the first version of Retirement Income for Life?
I was sitting in a seminar that was being given by a couple of actuaries, a couple of actuaries from Morneau Chappelle to a bigger group. This was at a meeting of the Canadian Institute of Actuaries. This was about 6 years ago now. And they were talking about these kinds of things, like how do we actually create income for life? And they were talking about the merits of annuities and other things. And I sort of got excited about it because I realized actuaries don't talk about this very much. You might think that all the stuff they talk about in the book, all actuaries know code. We don't really think about it. We have very specialized skills, very like small subset even for actuaries. And so they wouldn't know most of this stuff themselves. Anyway, when I listened to them, some ideas were popping in my head. I didn't actually agree with maybe half the things they were saying, but I started thinking we really need a book on this. I started doing some research on it. Found there were more than 1,000 Canadians retiring every day, at least reaching 65 every day. Yeah. And I also looked at the retirement books which are currently on the market, and all of them are about accumulating money for retirement, essentially for saving for retirement, and not about decumulating, which isn't quite an official verb yet, but about actually how do you actually spend down that money in retirement in the most sensible way. So I decided it's high time we had a book on this.
Yeah, awesome. Yeah, very cool. And a little bit of kind of how I found the book. So I found this book in 2018. So that's actually when it was first released. And at the time I was having a little bit of this internal dilemma with trying to be an ethical advisor, trying to offer the best advice that I could. But I was at a company where I was pairing that with high fee funds and stuff like that. And very shortly after reading your book, I actually found myself leaving that company and eventually finding my way to K4 and pairing your advice a lot better with those things. So it's also very interesting to hear that the kind of knowledge within the actuarial circles is very different on this. So I didn't realize that. Thank you. Your newest version of the book, so you have the 2018 version, you have the 2020 version. You wrote in April of 2020. So COVID was really in Canada in its infancy. I was only home from work at home for a month by that point. You make a couple of different adjustments or amendments, specifically because of that black swan event. Now we have almost 3 years of hindsight on that. What adjustment to the book was actually more important than you originally thought in 2020, or were any of them weakened or strengthened now with 3 more years of data?
I'd say the biggest outcome of COVID has been inflation. Let's face it, inflation, the spike we saw in 2022, which really hasn't quite gone away yet, all happened really because of COVID and the shortages and that were created, labor shortages and shortages in parts and in products and so on. And I guess I was thinking that inflation was pretty much dead, or at least under control. We've seen inflation around the 2% level ever since the early 1990s. And I thought, well, 30 years, that's enough to convince me. So that's how it's going to be. And so I kind of based my solution on inflation staying low for the long term. Now that it's spiked for about a year and a half, and as I say, it still hasn't quite gone down yet.
Right.
It makes me realize, well, you know what? Maybe COVID is essentially over. And maybe it's not going to come back, but it doesn't mean that inflation is dead forever. And we now know that it can spike. It's not dead. It's not a demographic phenomenon. We have a different population now, so we'll never see inflation again. We now know it can rear its ugly head anytime. We just don't know when it's going to happen again. But now there seems to be a much greater chance of it happening again. And as a result of that, it did change some of my some of my thinking on some things. For example, annuities. Annuities, at least non-indexed annuities. You would never buy an indexed annuity. The price is just too crazy, even if assuming it's offered. But if non-indexed annuity, before I figured, you know what, 2.2% per year inflation, that's manageable. It's only going to be like over a 20, 25-year period. And yeah, it'll be worth a little bit less. But when you look at the overall scheme of things, my charts and how it fits in just fine. But if we're going to have periods in the future where inflation kicks up to 6%, 7% for several years, suddenly those annuities don't look that great anymore. So that's one thing that changed. Old age security. This is almost the exact opposite. Before, I figured, man, it's 36% more at age 70 than 65. I haven't been able to convince anybody to defer Canada pension yet. So how am I going to convince anyone to get to defer old age security to 70? So I didn't bother trying. I didn't really put my mind to it because it just seemed to be like such a lost cause. But now that we know inflation can be a problem, old age security, 36% more, it's fully inflation protected, and I fully secure. You don't have to worry about your payments getting cut off ever. I don't believe. Yeah, maybe there'll be another clawback, but I don't think so. So that changed. Suddenly, that made a lot more sense. But anything that protects you against inflation more makes sense now. I would say compared with what I thought 3 years ago.
Yeah, absolutely. Yeah, I mean, whether you call it these days inflation, greedflation, shrinkflation, you see them all in the news. But yeah, it's definitely making an impact on plans for sure. And I'm very curious to see where FP Canada goes with their projection guidelines as soon as they release the new ones. I'm going to skip ahead a little bit because you were touching on CPP and OAS. So generally speaking, people take CPP at 60 or 65 or 70. And the literature is out there, including yours, that in most cases, with very few exceptions, the best financial option for people is to take it at 70. Yet less than 1% of Canadians actually do take CPP at 70. Why do so few people wait? And then if I can challenge you, can you convince me to take CPP at 70 in 2 minutes?
So those are two different things. You want me to look at the why so few people do it?
Yeah.
I guess what's happening is they are underestimating life expectancy, and they're overestimating the kind of risk-free return or risk-adjusted return they can get. That essentially is it. They think they're going to get a return on their investments of 5 or 6 or 7%, and they think that they're going to only live until 80 or 82. So that seems to be the main reason. Well, that's one of the big reasons, and then there's just the emotional reason. What if I die young? So when I tell people, I say at the beginning of my presentations, I tell them that, well, let's kind of figure out what your goals are first, and I think your goal ought to be to maximize your retirement income and ensure that it's going to last for the rest of your life. And my audience goes, well, duh, of course that's what I want to do. But they don't take actions. They don't take the actions that are consistent with those two goals.
Right.
They do take actions consistent with, what if I die young? I don't want to look foolish, in my coffin, because, I died at 72 and I took CPP starting at 70, so I only had 2 years worth of payments. So I don't want that to happen. So I'm going to do everything in my power to make sure it doesn't happen, even if I run out of money at age 86. That's why they don't do it. What if I die young?
Yeah. No, that's fair.
Can I convince you in 2 minutes to do it? Well, you know what? The way to convince you would be the charts in the book. I show a chart of people not taking CPP. They're doing everything else right in terms of having the right retirement target income and everything else in terms of investing properly, keeping their investment fees low. They do everything right, and however, they take CPP starting at 65, if not younger. And I show that they end up running out of money if they're drawing a certain amount, a fixed amount, which I fixed in advance. Now, if they draw the same fixed amount, but they now take CPP at age 70, they're no longer running out of money. And on top of that, the amount of secure income they have when they reach age 85 or 90, if they get there, is greater than the amount of secure income they would have otherwise. They have fewer decisions to make about, well, what do I do with my remaining RIF at that point in time? Um, but it's just worth more, as at present value terms. Look at what you like. If I was to ask you, what would you like to do? Would you like to get $100 from me today, or $105 from me in 30 years time? Sorry, let me put that the other way around. Would you like to get $105 from me today, or $1,000 from me in a year's time? And you're going to say the thousand a year's time because you gave the present value, and even though it's a year from now, it's still worth more. But if I said 105 today, 105 in a year's time, you would take the today because it's worth more. So you're doing a present value calculation in your head when you work this out. You work out that time has a value as well. It's not just the amount, the fixed amount. And people are kind of turning that off when they do the calculations. It's a very complicated calculation, taking mortality into account and interest into account and so on. But the calculation is a no-brainer for actuaries. If you do the calculation, it's just worth more.
Yeah, yeah, agreed. And yeah, I mean, the break evens usually, like you were kind of talking about 82, 83. It's usually where the break even is. And like you said, people are underestimating their life expectancy. We're seeing people live longer and longer than ever before. So
I had a chart about this actually in the Globe and Mail a few weeks ago, and I'm showing that people tend to think, well, that what they do is they look at life expectancy. They might maybe even Google it, and they find life expectancy in Canada is around age 82. Yeah. That would be the general population measured from birth. However, you ought to be measuring it from age 65, right. And it can also be for the general population. You should be taking the population that actually has savings, so that'll be a slightly higher income group than the general population. You take those two things into account, and the life expectancy for a male, age 65, is about 87, and for a female, it would be close to 90.
Wow, that's incredible. I didn't know that. Yeah, I mean, my wife's grandmother's 104. We just had her birthday party 2 weeks ago. It's unbelievable. In your book, you have 5 main enhancements that you touch on, and if you had, if you were talking to someone who had just retired, living through this volatility, living through this inflation, which of the 5 enhancements would you recommend that they visit first?
The first one's a complete no-brainer, like reducing fees. I actually don't understand why anybody would still be in funds, mutual funds, where they're incurring fees of 2% up and more than that. I know someone very close to me was in funds where they were actually, their overall fee level was 2.4%, and on top of that, there were also what you would call it, deferred sales charges, so that if they actually left at that point in time, they'd have to pay back to $12,000. Yeah. They actually forfeit another $12,000 on top of it, paying 2.4%. And we actually bit the bullet. I said, look, you got to do this. They bit the bullet. They incurred the $12,000 charge and left. And now they got their fees down to 0.5%.
Yeah. DSC, so, I mean, yeah.
So I show my charts that makes a difference of about 3 years worth of income. So if, for the sake of argument, if you were drawing at such a level that, if you're doing, but you don't defer CPP, that you were going to run out of money at age 81, you end up running out at age 84. So that you bought yourself 3 years right there.
That's huge. Yeah. DSCs have been like a boon in this industry for years. And for the most part, they're starting to get out. But what we've started seeing, so we have our $500 financial plan. We've been seeing lots of different cases recently. And what I've started seeing is lots of advisors have shifted more to the investment side because DSCs are still available there. And we've started seeing more and more segregated funds with DSCs with clients that were not the right fit. Let's put it that way. Very, very interesting. Yeah. All right. Renting versus owning. How does renting your home versus owning your home affect your financial, like, retirement projections?
Okay, that's an interesting question. First of all, my book, Retirement Income for Life, isn't about matching up your needs with your income and making sure you retire at the right time. My book is mainly about you've got your nest egg, you're ready for retirement, so let's kind of turn that into as much income as you can, without taking any undue risk. That's what it's about, and then it's up to you to decide if that's enough income or not. I'm not telling people how much income to retire with. My next book was more about that. My book, The Rule of 30, but essentially, This is very simplistic, but I would say people tend to think that their retirement income target is 70% of their final average earnings, gross earnings, 70%. But I think it's more like 50%.
Yeah.
And but I only say 50% on the basis that they owned, they bought a house, they were making mortgage payments all those years, and the house is paid for by the time they retire.
Right.
So a big amount of mortgage payments have gone away. And what I focus on is spendable income. And before retirement, we have all kinds of things that whittle down our spendable income. Yeah. We have taxes, we have saving for retirement, we have work-related expenses, and we have the mortgage payments, and of course we have children. I'm assuming the children expenses should have pretty much gone away by retirement. Mortgage payments should have gone away if you paid off your house. Work-related expenses go away by definition, and retirement savings go away by definition. All you're left with in retirement, the only thing that boils down your spendable income is income tax, really. So those are the only two things you've got. And I've shown examples. One of my examples was in the Globe and Mail, actually, that a typical couple is never going to have more than 40% of their gross income before retirement as being spendable income. If that's the case, then even if you gross it up for income tax, their target's never more than 50%.
Yeah.
So that's if you buy. If you own, your target's going to be a little different. It's probably going to be a little bit higher as a result of that, because you're still going to have the same rent issue after retirement as you had before retirement.
Right. Yeah. And I also read one of your interviews or articles where you talked about where that 70% number even originated. I believe it was a study done in the States. Is that correct?
Well, you know what? I actually haven't been able to totally pin it down. I did find, I think one firm, I believe it was Aon, but I don't quote me on that.
I won't.
But there was one firm that actually came up with a breakdown of it as to why you need 70% in retirement, and this was being quoted by one of the big investment managers down there, one of the people like T. Rowe Price or Vanguard, but one of the big ones who obviously want you to save as much as possible for retirement. So they're quoting this. That is why you have to save whopping amounts. And so they quoted this, and I looked at the breakdown of why you need 70%. And then it's kind of like, when you look at the ingredients of a cigarette, they have tar in there. So they had tar in this breakdown. There was like one thing that was about 15%, and this was for everything else. But what everything else? Their breakdown was extremely detailed. It was everything you could possibly imagine you're going to have to worry about in retirement. Then they just tacked on another 15% on top of that.
Yeah. That's ridiculous. Just one of those old school things that just has been ingrained, maybe. I don't know.
And you think about it, so it has been ingrained, it's in there. And who's going to want to see that come down? The investment companies certainly don't want to see it come down. Anybody who actually, I guess, financial advisors who work on a commission basis don't really want to see it come down. They want people to put away as much money as possible. Right. Nobody in government wants to see it come down because there are pension plans where, by the way, their target isn't really 70%. Their target's more like 80%, by the way, in retirement, in government and public sector.
Right. Very interesting. Another Global Mail article you recently wrote this year, you talked about what the best asset mix is for you in retirement. And you cited the old knowledge of 50-50, so 50% equity, 50% fixed income. And you said it's probably more like a 60-40 mix. Why is that such a big difference?
Well, there's actually two reasons why it's a 60-40 mix. What I was quoting in the article on the chart was I actually did a study where I just looked at returns. This would have been if you invested something like 30% in the S&P 500, including dividends, and 30% in the S&P TSX, and 40% in the Universe Bond Fund. And you rebalanced every year, so you always had that same 60-40 mix, and then did the same thing with a 50-50 mix. And I did this for 14-year periods going back to 1938. That was the first. So 38 to 52 would have been the first period, and so on and so forth, all the way up to the present time. And lo and behold, there was, I would say, never a time when 50-50 return would have given you a better result than a 64-year return over a 14-year period. I say never. In actual fact, there was one where you were better by 0.2%. So that was about it. That was shortly after like one of the greatest meltdowns of all time. That was the 2008, 2009 recession.
Oh, okay.
And why 14 years? There was a bit of science behind it. I'm looking at duration. So duration, I'm just looking at if you have an asset, say a nest egg, at age 60, 65, you want it to last for the rest of your life. You're going to be drawing it down over that period of time. So this asset that keeps on dwindling in amount over that time is about the same thing as having one lump sum amount over a 14-year period. So 30-year periods going down versus 14-year periods without a block of assets. That's kind of the same thing.
Interesting. Okay. Yeah, very neat. In 2022 in the Globe and Mail, you wrote an article about normal retirement age for Canadians and cited that we're one of the earliest of developed countries, or I guess all countries. When you pair that with statistics that say that Canadians have usually about a top 20 life expectancy, do we have it harder than other countries to financially plan for retirement, or do we have other things in place that make it maybe even easier?
Certainly you would think we'd have it harder just because of life expectancy. When you look at life expectancy and subtract from that the normal retirement age, it's just a longer period than it is elsewhere. Okay. What mitigates that would be, first of all, our healthcare system, where most of healthcare expenses are paid for in retirement. This isn't the case in every other country. It's the case in some countries, especially Europe. Not the case, say, in the U.S., for example, where there would be some expenses that you'd have to incur on your own. So healthcare would be one reason why our Canadians don't have it quite as bad. I guess that would be really the main reason I can think of right off the bat as to why it wouldn't be quite so bad for Canadians in retirement. Oh yeah, the other thing, of course, would be GIS, our Guaranteed Income Supplement, which it ends up being a very major factor for a lot of people. In fact, if you were in the bottom quartile in income levels at household income during your working years, you would never actually have to save a penny in an RRSP because you're going to still have more after-tax income in retirement from GIS, OAS, and whatever CPP you get than you ever had when you were working. And so that's actually one of the great misleading statistics, like when people say, oh, look how badly we're saving. We have half the population that's not saving anything at all for retirement. Well, many of that half the population don't have to save anything for retirement. So they're actually doing the sensible thing.
I hadn't thought about it that way. Interesting. This question you touched on definitely before. And so historically, like you argued the importance of delaying CPP and that you weight that a lot more importantly than delaying OAS. However, it seems like in a couple of your more recent articles that your tune seems to be changing a little bit. So why is the rationale for delaying OAS stronger than before?
Well, as I was saying, the main reason why the rationale is stronger than before is because of inflation. So the OAS is going to be fully inflation protected. At 70, it's going to be 36% greater than it is at 65. There is one major reason as to why you can't always delay until 70. I try to match to get the starting income at the level that is going to be not only sustainable for life, but also kind of meet whatever the target income is in year one. That when you adjust that for my inflation target in future years, you're always going to be able to stay on that target line, that target income line. So I don't think your income is going to have to go up with inflation. It does in your 60s, but after your 60s, it doesn't really go up with inflation anymore. It still goes up, but slower than inflation. So here's the problem: if you have $400,000, for example, in assets, and you're 64, for example, you and your spouse are 64. If you tried to defer both CPP and OAS until 70, you might barely be able to do it. They have enough assets in your RIF to do that. But as a result, it means that you're going to be way overshooting in your CPP, your overall income by the time you hit age 88, 90, whatever. It's like way, way more than your target income. So it ends up just creating the wrong curve. So I'm actually making adjustments for it. I'm spending a lot more time on that in the third edition to my book, which currently I'm writing. It's going to be released in October this year. And in that book, I'm going to say that there are times when the optimal age to be starting your old age security or CPP might be more like 67 or 68, or something between 65 and 70. I am also trying to create a means for people to work that out. It would be easy for me as an author just to say, well, it's not always 70 and look really clever and then kind of go away and leave people with a problem. But someone's got to figure out what it should be. So I'm going to actually have that facility. I'll be talking about that in the book, and may also be mentioning it between now and then, I guess, in articles in the Globe and Mail as to what that facility is going to be. I'm actually looking at a manual intervention. This is where people, I guess, under my supervision would be actually working out, well, how can I optimize when I should take CPP and OAS, and also what kind of annuity I should buy, if any, and how much of my money should I spend on an annuity. So those are all the kind of things I want to be trying to optimize. You think about it, essentially retirement income for life is an approximate solution. In my mind, in my opinion, it's a lot better than what people have been doing, but it's not perfect. And I'm going to be just trying to get that much closer to optimizing that solution by having that manual intervention.
Oh, very interesting. Yeah, looking forward to that. One of the most popular things people ask us about, or strategies people ask us about, is the RSP meltdown. So taking more from the RSPs in the early years to kind of manage taxes for the estate down the road. What are your thoughts on that? Or would you want to weigh in on like withdrawal order, RSP versus TFSA versus non-registered? What are your thoughts on that?
Well, you know what? I want to leave something for the financial planners out there. So I actually don't spend a lot of time in my books or in my writing talking about tax considerations. It's actually a pretty complex area. Yeah. However, I did look at it a little bit. There was actually one article you might have seen in Globe and Mail last year where I figured, well, by the first iteration, I thought, well, I guess probably the best thing to do is if you have taxable pots of money, say you after retirement, well, you want to spend those down first because you're not in a tax shelter like an RSP or a TFSA. So you want to spend those first, and then spend your RSP later on. So then I actually modeled it, and I worked out the present value of the after-tax amount of income you're going to get for the rest of your life if you do that. Like you draw down that first and then draw down your tax shelter later. And I was actually surprised to find that you were better off if you actually took a little bit of that, of the after-tax money, the money that's exposed to tax versus the tax shelter, took a little bit of that each year. And I tried to figure out why that was the case. And I found that these people were actually slipping into a higher income tax bracket if they took all the after-tax first and then they took all the tax shelter later. They were actually going into a higher income tax bracket that they would never actually touch if they just average it out. So I am now in my tool, in my PERC calculator, I am assuming people are going to be taking a little bit from each on an annual basis. I still haven't optimized it, I'm pretty sure. I think it's better than doing it the other way around, but as I said, that isn't something I've focused on.
Okay, no, that's fair enough. And you mentioned your PERC calculator. What is that? Can we link that below?
PERC calculator. Okay, PERC, Personal Enhanced Retirement Calculator. Enhanced kind of touches on, the word I use a lot in the book, the enhancements, my 5 enhancements to retirement. So that's why I use that. And it's simply an acronym, which, as it turned out after the fact, that seems like it's a pretty popular acronym for all kinds of different products out there on the market. Nothing to do with retirement, but all kinds of other things like fertilizer or whatever. So anyway, But in any event, it is out there, and it's kind of caught on. So I might keep on using it. So the calculator is a tool that is free. It's available right now. It's on a website, LifeWorks website. It's going to be moving very, very soon. It's also going to be updated to take into account the inflation and also the new numbers for 2022, 23 for things like CPP and old age security and all that. In any event, it's a free calculator. There's no obligation to use it for using it. You don't have to sign on for something or for a mailer or anything. I don't keep anyone's email address. I don't use that. It's simply I made it available because otherwise I would have felt guilty having a book talking about here's all things you should do in retirement, and then I don't tell them how much income they can actually draw. So PERC is your first estimate of how much money you can safely draw in retirement, hopefully more than people thought they could draw, and maybe it'll alleviate some of the anxiety of when people worry that they're drawing too much. It's all based on a fairly pessimistic investment scenario that you're only going to meet a 10th percentile investment return in the future. So if you and it shows that the income is sustainable on that basis, and 9 chances in 10 you'll do better than that in actual retirement.
Awesome.
So and it takes everything into account, all the sources, and also shows the income you would have got before the enhancements and after the enhancements.
Very interesting. Well, we'll link that below, and we'll figure out how to make sure it's the updated link once it moves as well. It'll be in the description below. So I guess really the last question is, so we're filming this January 24. Tomorrow is January 25, and it'll be the first rate announcement from the Bank of Canada for interest rates. Long term, where do you see rates going? Where do you think that needs to be for like a healthy Canadian economy? What are your thoughts long term on rates?
Well, for the longest time, I've been saying that demographics are dictating that interest rates are going to be staying low for a long, long time to come. Now, we've had one of the most remarkable events of the last century happening, of course, in the last 2 years, being COVID. And the pandemic has changed the world. In some ways, maybe it changed the world forever. I still see people walking around on the sidewalk alone with a mask on when no one else is around. And so things have changed. People's perception of risk have changed and so on. And what it did, of course, is it caused interest rates to spike a little bit. They spiked a little bit because inflation spiked a little bit. So I never said demographics would always keep inflation low. I just thought that the Bank of Canada would do that. But inflation did spike, as we know. And so they had to, so interest rates had to rise as a result. I think it's a blip. The fact that right now we see long, say 10-year bond yields in Canada at around 3%. It was more typically like 1.5% to 2%. So, but think about it though, the most remarkable event of the past century has happened, and all it's done is raise interest rates like long bond yields from 2% to 3%. It hasn't reached from 2% to 12 or 18 like it did back in the. So I would still say the demographic effect is still very, very strong, and I still think that interest rates are going to be staying pretty much under control, especially after this current bout of inflation is over, for the long term. So I don't think we can ever say look forward to a time when you want to buy a 5-year GIC and you want to get 7% interest again. I just don't think it's going to. I don't think anybody should be counting on that happening.
Yeah. Those days are behind us. Awesome. Well, Mr. Vettese, thank you so much for taking the time with us today. This has been a pleasure. I feel really lucky to have had the opportunity to talk to you and pick your brain a little bit. For those of you watching still, thank you so much for the views. Please like and subscribe. And the bigger our channel gets, the more really cool things like this that we can do. So please like and subscribe. And until next time, keep planning. Bye. Okay.